Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohart University of Science and Technology. The title of this course is Business Finance and the course code for this subject is BS 151. This is lecture number 29 and the topic for today's discussion is working capital management overview and different issues pertaining to working capital management. The outline of this lecture comprises of the discussion regarding what is gross working capital, what is net working capital, third, the significance of working capital management for manufacturing or other corporate sector, and fourth, the working capital management issues which are impacting the company's profitability, risk, and liquidity. So let's discuss certain concepts related with working capital management. So what is working capital? Working capital is actually the level of investments of the company in the current asset of the company. So bear in your mind that we have a balance sheet of a company and its assets are bifurcated between the current asset and the fixed assets. So the working capital is related with the management of current assets of the company, like cash, how much level of cash should be maintained, what level of account receivable shall be considered as optimal level for the company, and what level of inventory should be managed. What is net working capital? Net working capital means to subtract current liability from the total level of current assets. Let's suppose if the company's total current assets are $100 and the current liabilities of the company for same year is $80, then the net working capital is $20. 100 minus 80 is equal to $20. That is known as net working capital. What is the gross working capital? The gross working capital is the the company's investment in the current assets like cash, account receivable, inventory, and supplies, which are convertible into the cash within 1 year of time period, are considered as current assets. And those assets which are used for generating the revenue for the company over the period of time, like more than 1 year, those are fixed assets. However, the current assets are those assets which may be converted into cash within 1 year of time period. So this topic and lecture will discuss and focus the current assets phenomena or availability in the balance sheet of a company, and how to manage them is known as the working capital management of the company, like to select the optimal level of assets in the current level, and rest of the assets or amount should be invested in the fixed asset like machinery, building, equipment. So what is working capital management? It is the administration of the firm's current assets and the financing needs to support the current assets. So we can conclude that working capital management is the administration or supervision of the current assets level in the company that may provide the best optimal results for the company's balance sheet and different financial ratios, and as well as the company's profitability. Now let's discuss the significance of working capital management, like why it is important and what is its significance in a company. So in a typical manufacturing firm, the current assets exceeds 1/2 of the total assets because the manufacturing company may have credit sales and it requires to have larger level of account receivable, and as well as the raw material or inventory level is quite higher in the manufacturing companies in comparison to the services sector. So typically we have one half of the total assets in the current assets of the company. Let's suppose if the company has $100 of total investment in total assets, then $50 are stuck in the current assets and $50 have been utilized in the fixed assets of the company. Second, excessive level can result in a substandard return on investment. Working capital management is really important because it not only impacts the risk factor of the company, but rather it also, or at the very same time, it also impacts the return on investment, which is a profitability measure for the company. And if there is high level of current assets in the total assets of the company, then it will result in a substandard or poor return on investment indicator. Third, the current liabilities are the principal source of external financing for the small firms. So the small firm particularly emphasize on the current liabilities, which are short-term liabilities, are to be paid within 1 year of time period. Therefore, such liabilities needs to be paid out from the current asset source. This is why the management of current asset is really important for a manufacturing company in particular. It requires continuous day-to-day managerial supervision because the current assets keep on changing within 1 year of time period, and its shape has been transforming or changing into the other current asset. Like for example, account receivable may be collected within 15 days and those account receivable may be turned out into cash. Similarly, the inventory or the finished goods available in the inventory level of the company may be sold out and turned out into the account receivable. So working capital management affects the company's risk. It also impacts the company's return and the share price as well. Let us discuss the working capital management issues. The optimal level of current assets need to be selected. We have certain assumption in order to understand this working capital management issues. We assume that 50,000 maximum unit of production has been happened in this company. There is a continuous production of goods in this company, a firm. And then third assumption is 3 different policies for current assets level are possible. So let's come towards the graph. The y-axis shows the level of current assets in the company, and the horizontal axis or x-axis shows the number of units produced by the company. And we assume that company is producing 50,000 units with 3 different policies, policy A, policy B, and the policy C regarding the working capital level or level of current assets in the company. The policy A shows that the level of current assets to be maintained in the company is on this particular position. Let me select a pen to explain it clearly. The policy is showing us to have this level of, let's suppose we are assuming it to point number 10. So 10 level of current assets are required in policy A to produce 50,000 units. Similarly for policy C, which requires the current asset level to be quite lower than the policy A, which could be, let's suppose, 6 units of current assets. It means that we require less number of units to produce the same number of output by utilizing the lower number of current assets in the company. So policy A pertains to the high level of current assets in the company. Policy B is to have the average number of current asset level in the total assets of the company. And the policy C is related with the lower number of current assets and then to produce the same number of units. Now what could be these the impact of each policy on the company's profitability, its liquidity, and the risk will be discussed shortly. So it is very important to have an eye on the working capital management because it has certain impact on the liquidity of the company. So let's discuss the first impact of working capital management on liquidity of the company. So let's suppose if the company has high level of current assets, like for example, the total assets in the company are 100 and the current asset is 40 and the fixed assets are 60 rupees or dollars. And similarly, in policy C, we have lower number of dollars in the current assets and maximum number are stuck in the fixed assets. So in this case, we have lower number of assets in the current assets, whereas larger number of dollars are stuck in the fixed assets. So this pertains to policy C and this pertains to the policy A. So what is the impact of this different level of current assets on the liquidity of the company? In order to understand what will be the impact on the liquidity of the firm, we should first of all know about the liquidity phenomena, and by liquidity means how fastly certain assets can be converted into cash within 1 year of time period or whatever the time period is. So the faster the time period, the lesser the number of days required to convert a particular asset into the cash, we will assume that the company has high level of liquidity because the assets of the company can be converted into the cash in faster period of time and near to the original amount. So in that case, the company's liquidity will be considered as high. So when the company's liquidity will be high, we can say that the larger number of current assets the company occupies in the current assets, since we know that the current assets are normally converted into cash within 1 year of time period, like account receivable collected into cash within 30 days, and similarly the inventory or product life cycle requires to be manufactured and then to sold out, which is known as operating cycle as well. Selling the inventories, account receivable generated, and then collection of account receivable. So the inventory may also be turned out into the cash within few months or few number of days. However, the fixed asset of the companies are intact for the number of years in the company, which helps to produce the finished product or to generate revenue, and these fixed asset cannot be easily converted into cash of the company. So therefore, we can say that the liquidity of the company will be lower if there is greater number of dollars stuck in the fixed asset. However, when there will be greater number of dollars in the current assets, the liquidity of the company will be high. Just like in policy A, when the level of current assets in this form or in this policy is high, then we can come towards the analysis of this liquidity impact on the liquidity by managing different policies or working capital policies. So in policy A, we can conclude that the liquidity of the company is high because it has maximum number of dollars stuck in current asset in comparison to policy C. And we can see that in policy C, we have less number of dollars in the current assets. As mentioned, $20 are stuck in current asset and $80 are in the fixed assets. So therefore, we will have low liquidity for policy C if this company is going to adopt. So greater the current asset level generate more liquidity, we can conclude, if all other factors held constant. If the rest of the factors are held constant, and if the company increase the level of current assets, it will increase the liquidity of the company. Let's discuss the impact of working capital management on the second factor, which is known as expected profitability. So what is the impact of working capital management on profitability? Once again, we have the same policy A for higher level of current asset and policy C for lower level of current assets. Dear student, bear in mind that we have assumed that all other factors will remain constant, and then to explain what will be the impact of high level of current assets on the profitability of the company. Since we have assumed that total assets of the company are $100 and in policy A there were $40 in current assets and $60 in fixed assets. Now we have assumed that all other factors will held constant, so therefore the $60 will remains as it is, and we are going to increase the investment of this company in the current assets only. Like if we are going to increase current assets by 60 and the fixed assets of the firm remain as it is, then what will be the impact of this policy on the expected profitability of the company? So dear student, we have a measure of expected profitability or the profitability measurement tool or a ratio which indicates whether the company's profitability is increasing or decreasing. The formula for return on asset is to divide net profit of the company by total number of assets. Here we can see that by policy change we have $120 in the total assets of the firm, and in the previous case we had only $100 in the total asset of the company. So if we divide the total net profit of the company by total assets and we assume that the net profit was 20 and the total asset in first case were $100, then the return on investment is 20% of the company. However, when we increase the level of current asset, what will have impact on the company's profitability indicator? So in the next phase, we have to divide the same profit, which is $20, by the total number of assets, and we know that the total number of assets are equal to the current asset of the company and the fixed asset of the company. So therefore we have $60 in current assets this time, and then we have $60 in the fixed assets, so it will come up with $120 in total. So after dividing this 20 by 120 level of total assets, we will have the return on investment of 16.66%. So we can see that if we increase the level of current assets in the company, it will reduce our profitability, which was previously 20%. However, after increase in the level of current assets, our profitability has been reduced to 16.66%. So let's conclude the impact of current assets on profitability. So when there will be high level of current assets in the company as in policy A, the profitability of the company will be lower. When the company will have average level of current assets, it will have once again the average profitability. And when the company will keep less number of resources in current assets, it will have high level of profitability on the basis of return on investment. So let's conclude our finding. There is same diagram and same graphical representation with the profitability analysis, that if the company adopts policy A, it will have low profitability. If company adopts policy B, it will have average profitability, and when the company will follow the policy C, it will have high level of profitability or expected profitability. As we know that as the current level or current assets level increases in the firm, total assets will also increase, and then the return on equity will decline, as we have explained previously with the help of a numerical example. Let's discuss the working capital management impact on risk factor. As we know that there is a direct connection between profitability and risk, and we have explained in the previous example that when there will be high level of current assets, the profitability of the firm will be lower. So there is a direct nexus between the profitability and risk factors. So we can conclude in this fashion also, when there will be lower level of profitability in policy A, we will have less number of risk faced by the firm. So we can see that when there is a decrease in cash, that is decrease in current assets, once again it will reduce the firm's ability to meet its financial obligation. Like in policy C, we have lower level of current assets. When there will be lower level of current assets, the profitability or risk factor to meet its obligation will be higher, and there will be chances to have the greater expected profitability. Secondly, if we have the strict policies in terms of credit sales, we can reduce our receivable, and possibility of loss of sale is there. So when we are going to lose our sale, we will face more risk, and when there will be high level of risk, there could be the greater number of profitability or expected profitability chances as well. Lower level of inventory, company will have the greater level of risk. So on impact, discussing on the impact on risk in comparison or in nexus and relationship with the working capital management, we can conclude that if the company has low level of current assets, if the company has greater number of current assets as in policy A, its risk factor will be lower, because the company's liabilities obligation will be met very easily. Similarly, in policy C, we can see that we have lower level of current assets in policy C, then it will have, or we can bear or face the high level of risk in the firm in terms of not meeting the obligation, in terms of loss in sale, and in terms of the liquidity of the company. So when there will be lower level of current assets, the company may have high level of risk factor on meeting its debt obligation, and as well as the possibility of losing the sales or credit sales and account receivable. So we can finally conclude that risk increases as the level of current asset reduces. So it depends upon the company's policy either to reduce the risk or to increase the risk, depending upon the level of current assets, by keeping all other factors constant. So let's summarize our discussion on working capital management. Here is a summary of optimal current level of assets and its analysis. We can conclude that in policy A, which was having the greater number of current assets, when the company's current assets are high, the company's liquidity will be greater. However, the company or the firm may face lower profitability and lower level of risk. And we have also discussed the nexus, the relationship between risk and profitability. When somebody is going to take high level of risk, there are chances to have greater number of profitability. And when somebody, a risk averse investor, is going to face a bare lower level of risk, then there will be chances that expected profitability from that investment may be lower. So that theory has once again been proved in the context of working capital management as well. The policy B was average, so therefore the company's liquidity will be average, its profitability will be average, and similarly the company is going to bear or face average risk. However, if the company is going to have lower number of investment in current assets, its liquidity will be lower, the ability to convert its asset into cash. Its profitability will be higher as proved with the help of return of investment formula by keeping all other factors constant. And then the company might have the high level of risk as well, that is the chance of losing the sale or the chance of having lower level of liquidity. So we can conclude that profitability varies inversely with the liquidity. However, the profitability varies together with risk, and return go hand in hand, as has been explained in the risk and return lecture as well, that there is a direct relationship between profitability and the risk of the company. So this was all about the discussion related with working capital management and different policies pertaining to the level of current assets in the firm. Thank you very much for listening to this lecture. If you have any question, feel free to post them on KCMS and I'll be happy to answer your question. Another way around, you can also email me your confusion on my official email address as mentioned in the footer of this lecture. Good luck for the day. Allah Hafiz.